I wanted to make a video to show you what the real culprit in this portfolio is, why we are at this drawdown, why it's at worst case drawdowns, and it's not what you think it is. We focus a lot on the stock indexes, and the stock index portfolio that we showed in the previous video is actually not at worst case drawdown. So what is the real culprit in this portfolio? I save this as a download scratch too, and I'm just going to delete the gold. Gold has been really hard to trade, really choppy market. What if we got rid of gold? Crude oil. What if we got rid of crude oil? We just didn't trade gold and crude oil. What would this look like? And you can see the worst case drawdown is 34,000. It's only in a $17,000 drawdown, so that's most of the losses right there. It actually had a good August instead of down. It's down this month, and if you take a look here, it's not at a worst case drawdown. The worst case drawdown was back here, and these are very fast recovery drawdowns. And so you see some of the strategies we're trading in the stock indexes are better for the current market than in the past market because there is more volatility for, say, for example, the NASDAQ breakout strategy. So these recoveries happen quicker. They're longer back here historically, and just a really a much better drawdown curve without gold and without crude oil. What happens if we just traded? What do just the NASDAQ and the S&P strategies look like in this setup? Just get rid of silver. You can get rid of your data fees, especially if you're like me. You pay pro data fees on all these COMEX and NYMEX and CBOT. And these markets have been tough. I thought soybeans. We had some good trades in soybeans, but overall, soybeans has a tendency to be choppy as well. So what if we just trade the stock indexes? Let's look at the drawdown now. It's still in a $17,000 out of $36,000 drawdown. But I love the cyclical nature of this drawdown curve. And so the worst case drawdown is back here. It's made these spikes in recent years, spiked there, it spiked, and it's the $17,000 drawdown. And we've had more volatile commodity markets, so one of the considerations is to manage those commodity market strategies. We don't want to jump in here now and give up the the bounce back potential from where we are. But going forward, ideally we want to get a bounce back, and then we want to look at maybe adjusting our commodity strategies: gold, silver, copper, crude oil, soybeans. If those become more volatile and are the ones that are really hurting us. So that's what I want to share with you. Perspective. Like I said, we talk a lot about the stock indexes because we have more strategies. There's a higher level of interest and more information, but this may not be the ones that we need to adjust going forward when we get out of this drawdown. We may look at the commodity markets and adjusting those strategies. And we thought of that since the stock index portfolio is not at a worst case drawdown in the portfolio setups. So and in the portfolio we're trading, the stock indexes are not at the drawdown. So that's what I want to share with you in this quick short video on the 200K portfolio.